Okay, to calculate the goodwill, so we start off with consideration transferred 480, which is here. Okay, consideration transferred, and fair value of NCI given here is 270. Then less fair value of net asset, so we have ordinary share. Ordinary share given is 15, retained earning is 39, and OCE. So retained earning, OCE, other component of equity, 150, 390, and also 36. And the fair excess of fair value identified net asset is due to a piece of land. There's a fair value adjustment of 84. So whenever you add in 84 here, okay, so of course you have to add to your PPE, and there could be an additional depreciation. So because it's a piece of land, so there's no additional depreciation, and no PPE because this is a SPL. Okay, SPL, so don't have to adjust in the PPE. By right we should lah. Okay, so add up this one, 540 plus 36 plus 84, 660, 675. So we have 90 as our goodwill, and goodwill has been impaired by 10% last year. So we are 2016. However, 2016 the impairment has been reversed. So impair last year recorded 10% impairment, so 81, and it has been reversed, and goodwill was valued at 3 million above. So reverse 9 million plus 3, so reverse 12. The upward change value has already been included in the draft. So meaning the impairment is an expenses last year, so reversal by right is income. Okay, but this is goodwill, so we do not, as per the standard, we do not reverse goodwill. Once it is impaired, it will remain even the value has gone up. So once it is impaired, the even after the value has gone up subsequently, we do not reverse. Okay, a normal PPE, when it's a reversal, yes, it is an income, but goodwill, no reversal, but it has been included as income here. Okay, so we must take it out. So this is the income statement in mincy. It has been included 12, so we must take it out. Okay, so admin cost, because admin cost, normally impairment charge in admin cost, we plus to the admin cost if it's a expense, but if it's a income which has been included, we must take it out. Okay, so we're going to take out the income. So because this is negative, we're going to increase back the expenses. Okay, example here, if it's 90, if there is an impairment, we, this is a bracket, so we 90 impairment is an expenses, so we minus another 99 lah, assuming, so it's negative 99, but because it's a reversal, so we plus. Okay, so you plus 12, plus back the expenses. Okay, anyway, you refer to here, it is a reversal of an income, so impairment of goodwill is already included in the gross profit. Reversal has been included, so we take it out. Reversal has been included as income, so we take out the income, minus out 12. Okay, alright, anyway, it should be a reversal of an income, reversal of an income. Alright, next. Note number 2. Mincy dispose of 10%. I rub this off. Mincy reverse dispose of 10% equity in Nando. Original is 80% and sell off 10%, left with 70 on 30th April, means at year end, for cash consideration of 108 and accounted for the gain or the loss in other income. So sell 10%, accounted for the gain or loss in other income. So this is a change, this is a no cross in accounting boundaries. This is purely a transactions between owner. Transactions between owner means my NCI is 20% and now NCI becomes 30%. So NCI means I got more NCI. So NCI is also the owner. So we sell 10% to other owner. Is a transactions between owner. So we know that with transactions between owner, it won't appear in group account. Okay, any gain or loss won't appear in a group account, but it will appear in the it won't appear in SPL group account, but it will appear in SFP under parents adjustment in parents equity. Okay, so it won't appear in SPL group. So we are now preparing P&L group. So it won't appear in the income and expenses, but it will appear in the parents equity in our SFP. Okay, so group gain or loss from your sale of the 10% won't appear in the SPL. It's a transactions between owner, adjust in the parents equity, won't appear in a P&L. So the carrying value of the net asset of Nando was on this date is 720 before any adjustment on consolidation. So mincy accounts for investment in subsidiary using MFRS 9 and has made an election to show any gain in OCI. This is financial instrument. Investment up or down, you go through OCI. Okay, so sales, cost of sales, gross, all the way to profit before tax, profit for the year, OCI. So any increase or decrease in your investment, up or down, you go through here, OCI. So the carrying value of the investment in Nando's was 540 2015, 570 2016. Repeat here. Carrying value 540. Carrying value has increased to 570 in 1 year. 2015 increased to 2016. Increased by 30 in 2016. Increased by 30, and it will appear in OCI. And when come to the 30 is included in OCI, meaning included in here. So we must take it out for console purpose. In the individual mincy account, increase in the value of the investment included in individual parent accounts 30 is correct, but when come to console we have to eliminate the 30. Okay, so it will appear here 60 minus the 30, which is 570 minus 540. Take it out for console purpose. Okay, meaning we left with 30. This one is for other investment lah, not in subsidy but other investment. Okay, now I rub this off. Okay, so at year end, it is now last year end, means beginning of the year it was valued at at the end of the year it was valued at 570. From 540 increased to 570, so it is now at 570 at 80%. 570 at 80%, and we sell off 10% for 108. So what's the cost at 10%? Because in our book it is 570 at 80%, so the value of 10% will be 570 divided by 80 times 10. So the cost is 71.25, and we sell it for 108. We make a gain of 36.75. This is recognized in parents book, so we must take it out. So we took out two things, because during the year increase from 540 to 570, the 30 we take it out, and now that we sell it for 108, the 10% we sell it for 108, we make a gain. So we, for console purpose, we must take it out, and they say here it's included in the other income. Here, other income. Okay, the gain or loss has been included in other income. So this is the other income. We must take out the 36.75. So we took out two things. First is the increase during the year, beginning until the end increase. Take it out for console, and this is for the 10% gain. Take it out for console purpose, because the 10% for group, it should be recorded, calculated separately and recorded in parents equity. So take it out, 36, eliminate lah. So eliminate the increase. This is the gain from the sale of the 10% recorded individually, individual books account. So we take it out, and you left with 89. Okay, this is for note 2. So before continue, note 1, calculate goodwill, and because the last year already impact 9 expense, but for goodwill there should not be any reversal, even the value has increased. So but they have already reversed, so reverse is an income, so we took out the income. Okay, took out income from the mincy accounts. Adjustment number 2, we adjust two things, because from individual company parents book, they recognize the 30 increase in the value, but for console purpose it must be taken out. So record 30 is correct individually, but for group take it out. Then from the 570 they sell 10% for 108 at cost of 571.2. Take out also the 36. For console purpose we take it out. Individually is okay. In parents book, okay. Console, take it out. Okay, next. Mincy sold inventory to Nando. Parent sell to subsea 30 million. The mincy made a profit on the transaction 6 million. Nando still hold 15, so parent sell to subsidy. Subsidy still hold half of it, means still half is unrealized, URP. Okay, parent sell to subsidy 30 million, so it must be included in the sales and included in the purchase. So we must take out minus sales minus purchase and adjust for the URP. Take out the URP, unrealized profit, eliminate the unrealized profit, take it out, the profit. So the adjustment will be parent sell to subsidy minus 30 million from here minus purchase from here, and because of the parent make the profit, parent made 6 but 3 still unrealized, we add to the cost, hence reduce the profit. So the net effect is minus 30, and here we minus 27 because plus 3 and minus 30, net minus 27. So if you look at the answer here, 24 plus 69 minus 30. This one you ignore the bracket. 1872 390 you plus, and then you minus out the 27, you get 2235. So minus 30 plus 3. Okay, so this one is easy. Okay, minus and you plus URP, minus sales minus purchase plus to the cost. This is URP. Parent sell to subsidy, so adjust in the parents P&L for this 3. Okay, but if it's subsidiary, sell to the parent, then the 3 we adjust it here. Under subsidy. So when it affects subsidy, it will affect the profit. Hence, it will affect the NCI. But this question, it is the other way around. It is parent that is selling it to the subsidy. So parent make profit, and parent will have to adjust out the URP. Okay. Next, the following information relate to mincy's pension scheme. Okay, so this is a IS 19, MFRS 119. Plan asset, this is asset at 1st January. Defined benefit obligation, this is liability. 1st January, so asset and liability. So liability more, so I have a net 15 liability at the beginning, brought down. Service cost for the year 30th April. So this is current service cost. Before current service cost, we have a, normally we start with 15, and then we have the interest. Interest 10% will be 1.5. So interest is an expenses because this is a liability we owe, so we charge a 10%. This is interest expense, charge to SBL expense. Current service cost is because they work extra 1 year, our liability increased by 18. So liability up, expense also up. Past service cost, this one the retiree, we charge additional 12, we pay them additional 12, so we owe, increase our liability, increase expense. Okay, current service cost, past service cost, liability up, so this is my total liability 30, 45, 46 and a half liability, and remeasurement loss of 9. So remeasurement loss of 9. so it should plus, not minus, because this is a liability. So it's a loss, means the liability has increased. So this one go to OCI. So total 55.5. This one go to SFP, but not in this question here. This is a non-current liability. So what we are doing here is for SPL. So this one will go to SPL. Total will be 31.5 SPL expenses, and 9 will go to OCI. 31.5 net service cost SPL. Whereas for the 9 we go to other comprehensive income, OCI. Repeat here. During the year we charge 1.5 interest, because this is a liability. So 10% interest will be expense. If it is an asset, the 10% will be income, interest. So this is a liability. So we charge all this to SPL 35.5. This one go to OCI. Both expense, and this one is a loss. Okay. Next, number 5. On 1st of May, mincy purchased item 2 years ago, and it's 37.5, and this is being depreciated straight line over 10 years, 2 years ago, with a zero residual. And last year the asset is revalued to 40.5, but at 2016 the value has fallen to 27. So they uses the revaluation model, and it has not been taken into account in the OCI, but depreciation has been charged. So depreciation okay, OCI not okay. So 37.5 cost is 37.5 accumulated depreciation 10 years with a 0, and this date you revalue to 40.5, 3.75, 33.75 carrying value. Okay, this is on 2015. Revalue to 40.5. Revalue by 6.75. So it will appear in here RR 6.75, but this is last year. Okay, so our reserves now will be 6.75 from last year. We are now in 2016, and continue depreciation. $40.5. Still got 9 more years to go. 4.5. 36. This is 30th April 16, and it will be revalued to 27 million. So current year it will be valued to 27 million. So your revaluation deficit down 9. Okay, so revaluation model, when it's up we go to RR, when it's down we reverse out RR. If more than that, only we go to P&L. So in this case here RR 6.7. so reverse out everything, but we're going to down by 9, so the other 2.75 we charge to SPL 2.25. okay, debit reverse the whole thing, debit to P&L, so RR will be 6.75 minus SPL 2.25 expense. Answer. PPE 2.25 expense 6.75 is a reversal. Put it here, meaning we have a reversal, we put it here 6.75 reversal down, and we have a impairment here minus 2.25, one in P&L, one in OCI. Done. Two years ago, Mincy award 6,000 share options to each of its 6 directors. 6,000 shares for 6 directors, and the condition attached is that the director must remain employed for 3 years. The fair value of each options granted is 225, and the fair value increased to 285. So we always use the fair value at the date when it's granted. Okay, it is granted here 225, so we continue to use 225. This one can ignore. So 1 year later, it was estimated that one director would leave before the end of 3 years. 1 year later, one is estimated. The estimated director who are going to leave will revise to 2 in 2016. So expense has regarded the share has not been recorded. Expense haven't recorded in the current year, and no director has left by 2016 lah. Expect only 2 lah. So /30th April 2017, 30th April 2016, 30th April 2015, 1st of May 14. So it was 6,000 shares were issued. So here we are in this financial year, but we need to know the movement, so we need to find 2015. So in 2015, one director would leave. So at this date, /30th April 15, expenses and liability, 6,000 shares will be issued to how many directors? 6, but 1 expect to leave, so we expect only 5, so we estimate only 5 directors, 6,000 shares each, and the value of each shares is 225. And do not forget to take 1 divided by 3. 5 times 6,000 times 225, the granted, divide by 3, so 2250. Liability 225, increase expenses 225. This is last year. This year, the estimated director expect to leave is 2. So when come to this year, now it is down to 2. So 6,000 times 6 minus 2, I expect only 4, times take 225 times 2 over 3. So the liability increased to 3600. So from 225 increased to 36, increased by 1350 this year. So this is 1.35 million charged to P&L. Here. Okay. Alright. So all adjustment has been made. So these are adjustment in the parent. There are no adjustment in subsidy. These are from the question. So add across. So parent plus subsidy, you have your total, and this is part of your working, and the profit shown here is all the way to profit for the year, and this is the OCI. This is a total comprehensive income. So transfer this whole thing as per your answer, or you can actually continue with profit attributable to owner of parent or NCI. So with this one first, how much you go to NCI? Because our profit is console profit, parent plus subsidy, we get parent and subsidy. So we console everything even though we own only 80%. So this one will be 100%, 100%, 27. However, this one here, 80% belongs to us, 20% don't belongs to us, NCI. But it's already included in here, the whole 100%. So out of 1/4, 20% don't belongs to us, so 22.8. This one will be the balancing figure. So you just take 273.15 minus 22.8. This is a balancing figure. Total comprehensive, $287.4. Same thing, out of the 1/4, %20 belongs to NCI. So this is the balancing. 287.4 minus 22.8 balancing. So the full answer is here. Okay, these are balancing figure. So you don't have to prepare this in the exam. All you do is, if you can, of course, if you want to save time, you do this way, and this will be your final answer, this column, and you just have to add in the profit attributable. Okay, now part 2 of the question is explained in another video. So this one is for console purpose, and for console purpose we only take parents equity and never show it in the SPL. So they ask what will happen in the parents equity. That will be explained in the next video, another video.